Hello and welcome to another installment of INSMAX Insurance Brokerage's Thursday webinar series. These are conducted every other Thursday at 1 p.m. Eastern Time, and we thank you for your attendance today. Our short webinar will cover the basics of commercial premium finance for life insurance, but before we get started, I'd like to provide a little information about who INSMAX is and what we do. We share ideas and concepts that solve real-world problems. We work for our advisors for their clients. We have over 20 years experience in the brokerage business, and we work with more than 30 of the major carriers. We also provide training and customer-approved marketing content so that you can approach your clients. We handle your contracting and licensing when your clients want to implement a plan. We take care of pre-underwriting to uncover and address your client-specific impairments and to determine the best insurance company for their risk. We also give our advisors all of the forms needed to complete the application, and we review those completed forms for errors and omissions. We handle the entire underwriting process from application to submission, including scheduling exams, obtaining medical records, and negotiating better offers with the carrier's underwriters. So in short, we are a full-service brokerage company that you can trust. We like to say that we're the insurance experts, so you don't have to be. Now, let's get into today's topic. Commercial premium finance. Well, we may have heard a lot about it, but what is it? We believe it's a very complex transaction that requires the use of very good partners. This isn't something that you want to try to do on your own. Our go-to expert in this field is Northstar Funding Partners, located in Arizona. With more than 20 years experience in this space, they are the single largest funder of financed insurance in the country. And their experience goes back through some of the difficult times that include the financial crisis in 2008. When a lot of other firms were exiting the space, Northstar remained and were funding policies and, more importantly, servicing all of their loans. They've got multiple bank relationships and are approved by almost all the carriers in this space. They would be happy to get on the phone to talk to you, your clients, their accountants, or anyone else, because they are the experts, so you don't have to be. So what is premium finance? Again, you might have heard a lot about it, but it's nothing more than a simple loan to buy large life insurance policies. Now, this isn't a normal loan that you can go down the street and get from your personal banker. These loans are a bit complex. So you need a specialty lender in this space who identifies all of the necessary requirements, understands life insurance, and the function expressly of cash value as collateral. The reason it's presently so popular is it's an alternative to a large outlay to pay for insurance that clients need but hate writing a check for. In any loan arrangement, it's very important to understand who's involved with the transaction. And in this one, there are three parties to the transaction. The first is the borrower. That would be your client, which could be in the form of an entity like a trust or a business or as an individual. Depending on the circumstances, it may be more favorable to use the trust, a business owner as the borrower. Next is the specific lender. Each lender has their own documents, their own set of requirements, and many times the carriers may want to review those documents. Finally, there's the insurance carrier. And those insurance carriers are going to be involved in a variety of things, including vetting the case for suitability and qualifying the client for the amount of coverage they seek. Now remember, not all carriers are offering policies in the space, in particular those that are financed. So it requires the use of specific policies. And one other thing I might want to point out is there is one other party to the transaction, and that would be the actual client who's getting the insurance. Obviously, this person may be the same as the actual borrower, but in certain circumstances, it's not. So let's talk about product selection. When it comes to product, Indexed Universal Life is the most popular product being used out there. It's got a floor of 0, and banks love the fact that when they loan money and the product cannot credit a negative return in a particular year, that gives them a lot of comfort. Generally speaking, Indexed Universal Life will outperform the loan rate from the lender and create the arbitrage necessary for the program to be successful. In some cases, we can also use whole life insurance. It's an excellent product with a lot of guarantees, again, that insurance companies like, as well as the banks like. However, term and variable universal life cannot be utilized. So the benefits of commercial premium finance are many. Your client can acquire a large amount of life insurance without giving up the use of other assets. Financing may also allow the funding of large life insurance at low interest rate costs without affecting current cash flow. We can reduce the premium outlay versus, say, 100% of what the client would normally have to pay. And we're going to take advantage of arbitrage. That is, we're going to borrow at low interest rates without liquidating taxable investments that may be earning a higher rate of return than the loan interest cost. We can also find a benefit with gift tax savings. For those clients that are gifting heavily into trust and may have exhausted their lifetime limitations, loans into a life insurance policy are not deemed to be gifts. So life insurance purchased with loans is a giant leverage play, and you've got to, again, have the right partner in this space. But there are other things to consider and other things to be concerned about with any loan. And in this case, I'd like to cover a few critical things. The first is interest rate risk. Since you're borrowing money, the cost of the loan is going to be dependent upon the prevailing rate at that time. Rates can also go up and they can also go down. While we're presently experiencing historically low interest rate environment, which makes premium finance very, very attractive, things can change. And as interest rates rise, the size of the loan and the cost of the loan will also increase. So that needs to be considered very, very thoroughly. Another consideration is the loan structure. Folks, if you've ever borrowed money from a bank to buy your house, you'll remember that loan document that was rather long and complex. Well, the same is true for a program like this. Every bank has its own caveats and requirements, and it's important, again, to have a partner in the space who's helped create a loan structure that's favorable to your client. Specific concerns can also be related to prepayment penalties and the actual duration of the loan and loan requalification periods. All of these are things you want to work out with the premium finance partner so that your client understands what's going on. An additional concern is policy performance. Since life insurance cash values will be a critical part of the collateral and maintaining the contract throughout the lifetime of the client, the growth on the cash value is important and should be monitored every single year. And then finally, collateral. Clients have got to post assets with the bank whenever the cash value of the loan is less than the loaned amount every year. That means collateral is going to be calculated annually by the bank in advance of the next loan amount or the premium payment. So your clients must be ready to have those collateral assets when the bank requires them. So since we're talking about collateral, let's go over this a little bit more detail. This is one of the most important requirements of the transaction because the bank always wants to be protected. And as such, they will always ask for collateral in advance of a loan that's going to be paid. Again, if you can remember one thing, remember this. Without collateral, the bank is not going to fund your loan. Heck, if you can remember your home buying experience, most of us had to put some money down, maybe 20% cash on our house to create some equity or collateral against the loan that the bank was willing to make. Well, the same holds true in premium finance. Fortunately, every time you make a premium payment, you create cash surrender value in the policy, which also serves as the primary source of collateral. So some banks will give you a percentage of the cash surrender value as collateral, and others will give you 100% of it as collateral. This is dependent upon the bank you work with, and we can certainly help you with identifying those banks and putting you and your clients in the right position. But besides the cash surrender value, clients may have to post alternative assets, such as cash equivalents, CDs, bank letters of credit. All of these are accepted by most lenders in the space. Some things that aren't acceptable by most of them are things like real estate or artwork, jewelry. Banks want things that are hyper liquid, and those items that I mentioned just a minute ago generally are not. But what's a loan without debt service, right? Clients have got many options in this regard when it comes to paying life insurance premium finance loans. They can pay principal and interest just like a traditional loan, or they can pay an interest-only loan. Whether that interest is due in arrears or in advance of the newest premium that's borrowed is dependent on the bank that you're working with. But another very popular design are levelized payments over the entire duration. That is, a client or business can budget a flat number to be paid every single year, regardless of whether they are amortizing principal, paying interest, or in some cases, capitalizing interest in the loan. Capitalizing interest is a fancy term for paying less than is owed to the bank, and then the bank takes that amount and adds it to the existing loan balance. Those structures do have their place, and we can talk to you about them as well. But before entering any premium finance transaction, we must consider three qualifications that are key to the success of the plan. One, is there an actual insurance need for the client? Two, can the client afford to pay the premium even if they weren't going to finance it? And finally, what is the exit strategy that does not involve death? That means, how does the client get out of this loan while they're alive if something goes wrong? So with that, let's take a look at how a transaction is put together. What you see here is the basic structure of any premium finance transaction. The grantor or trustee will secure a loan with the lender by providing tax returns, financial statements, and other requirements. And then finally, they'd have to post some collateral to the lender. After that's complete, the lender will make the loan, in this case to a trust, for the life insurance policy. Typically, the lender will send that premium directly to the carrier on behalf of the trust. The grantor then will generally make annual gifts of interest or other contributions to service the bank loan, and the trustee will make sure those gifts are used to send to the bank. At some point, though, the premium finance arrangement will end and the bank gets repaid. One way of repaying the bank is to borrow money or withdraw money from the life insurance policy, at which point the lender will retire the loan and release the collateral. That's it. Sometimes the collateral that's been pledged is the cash surrender value in the contract. So a release of the collateral assignment from the carrier would be executed. And in other cases, any additional collateral that was posted by the grantor would be released. In other circumstances, the loan can be repaid from outside assets and not necessarily by the policy cash value. In fact, some clients may want to wait for a specific liquidity event to pay off the bank, such as the sale of a business or real estate, or perhaps they have an inheritance that they've received, or maybe they're finally selling a portion of their portfolio that's appreciated at a greater rate than the borrowing rate. In any event, clients have access to the cash value in the policy or their own personal assets to repay the bank. And finally, a loan can be retired as a result of death of the insured. In this case, the life insurance carrier will pay the proceeds to the irrevocable trust, who will then pay off the bank, and the remaining death benefit ultimately goes to the beneficiaries of that trust. So with the structure covered, let's talk about a few case studies. So in this case study, we have a man age 63 who's looking for at least $5 million of insurance for business and personal needs. We'll first set a benchmark. And that benchmark basically is the out-of-pocket premium that the client would have to pay for the coverage if it wasn't financed. After running illustrations in this example, we determined that it would cost $106,701 for a guaranteed universal life policy paid to age 100. So that's our benchmark. We then tried to create savings for the client by showing a lesser outlay than this guaranteed universal life premium. It was determined that approximately $90,000 would be acceptable by the client, but only for 13 years. The resulting savings over that time frame was $347,000. If the client actually lived to 100, the total savings would exceed $3 million if it were reinvested at 7%. That's quite a huge number. So it's clear that this is a case where premium finance reduced the client's initial outlay and then saved them millions over time. Let's take a look at the quick view sheet, which shows how the money flows. So on this page, you'll notice the top row, and across that top row, you'll see the client's age, and you'll see the loan amount. You'll see the estimated interest rate that's being charged. You'll see their out-of-pocket, and you'll see the net death benefit. In our example, the client would borrow $483,000 in year one. The client would then fund about $90,000 plus some other expenses as part of the loan repayment. That's right here. Since the cash surrender value of $144,000 is less than the actual year-end loan amount of $483,000, the client's going to be required to post additional collateral to secure that loan. And if death were to occur, his family would receive almost $5.9 million in year one. In this page, we show what happens every single year from year one until loan payoff and then up to age 100. The client in this case is making his annual out-of-pocket contributions in the green column here, and that in the end, in year 13, he stops. In year 14, the significant loan is taken from the policy to pay off the bank, which leaves the life insurance policy intact with over $1.4 million. And then the death benefit continues again for the life of the client and beyond. Case study number 2. Here we have a younger male, age 48, with a huge estate planning need of $60 million of insurance. Using the same process as before, we calculated the level guaranteed universal life premium to age 100 as our benchmark. That amount is almost $585,000 versus the design we came up with, which had an average annual contribution to a premium finance case of a little more than $146,000, but only for 10 years. As you can see by the numbers on the screen, the premium savings are astronomical, especially when you consider that those premium savings over his lifetime can be reinvested for a potentially higher return. So the quick view report for this case, again, reflects a 10-year funding period for this client. We're going to retire the policy in year 14, meaning the loan in year 14, leaving more than a $60 million death benefit to be paid to the family at his passing. I would say that this is an extreme case of the use of leverage in premium finance, but it demonstrates just how powerful it can be if the client's willing to accept the risks that are involved. Finally, let's discuss the use of finance for supplemental income sales. Here we have a 36-year-old male who seeks an additional tax-favored income for retirement as well as insurance protection. The advisor and he have agreed to a $25,000 annual spend for 10 years. We have two options that are presented. One is utilizing $25,000 towards a leveraged premium finance design where we're going to borrow $200,000 a year. And the other, simply, we would allocate the $25,000 into the same index product for 10 years. So let's see the results. This happens to be a snapshot from our quick view ledger showing $200,000 of premium being funded over this time frame, $25,000, roughly speaking, annual outlay by the client. Then the loan is retired in year 15. And in year 19, income begins to the tune of $269,000 for life. Not all cases look like this, but when a client has youth, time, and resources on their side, anything is possible. This is another report we can create that will do a side-by-side comparison of financing versus non-financing. The non-finance design would generate income to the client of approximately $75,000. Compare that to the nearly $270,000 using premium finance. And you can see how this might be very, very appealing, again, to a specific client. So let's talk about target markets. We believe this is to be discussed only with certain high net worth individuals, clients with minimum assets from 2 to 5 million and at least $250,000 of income. And in these cases, a lot of them seem to work best with business owners or clients with large real estate holdings. That can also include farmers or others who have a lot of assets, but cash flow might be a little bit lacking. Possible uses are for supplemental income, asset protection, estate planning, especially with the tax rules changing in the next several years. Businesses might also consider this when acquiring large key person policies or designing supplemental executive retirement plans using this technique. And finally, I'll mention it again, great for those folks that have a lot of assets but are a bit cash poor, again, like real estate and farmers that are trying to pass it on to the next generation. So what's the next step? Well, the next step for us, hopefully, is a phone call from you. Please reach out to our firm to schedule a time when we can meet with you to discuss premium finance. We can put you on the phone with our experts, and together we can help vet your case to see whether or not it's worth pursuing. With that, I'd like to remind you that 2 weeks from now, we're doing another presentation on smooth sailing or lessening the sequence of returns, risk, and retirement income by using life insurance. Again, we want to thank you so very, very much for being our guest today, and we look forward to meeting with you very, very soon. Have a great day. Take care.